For the past 30 years, there has been one place on Earth where the whole world could borrow money for almost nothing. Wall Street knew about it. London knew about it. Every hedge fund on the planet knew about it. And now that place is starting to charge, which is why the biggest risk to the American stock market right now may not be in America at all. It's in Tokyo. Let me explain, because this is one of those stories that sounds like a conspiracy theory and is actually just plumbing. Boring, gigantic, trillion-dollar plumbing. To understand it, you have to go back to a bubble. On December 29, 1989, the last trading day of the decade, Japan's Nikkei 225 stock index closed at 38,915 points. That was more than triple its level just 4 years earlier. Land prices were even crazier. Between 1985 and 1991, commercial land in Japan's 6 biggest cities rose more than 300%. There was a famous joke at the time that the grounds of the Imperial Palace in Tokyo, one patch of land in one city, were worth more on paper than the entire state of California. The year after that joke peaked, the bill came due. In 1990 alone, the Nikkei fell from around 39,000 to around 20,000, cut in half in 12 months. By 1992, it was approaching 15,000. Over the following years, urban land prices fell roughly 80% from their highs. The total paper wealth destroyed, stocks plus real estate, has been estimated at over 1,000 trillion yen. That's several years of Japan's entire economic output gone. What followed wasn't a normal recession. Banks were buried in bad loans. Companies spent the next decade paying down debt instead of investing. Households braced for prices to keep falling. Economists later gave this condition a name: a balance sheet recession. But the practical consequence was simple. Japan's central bank had only one lever left: cut the price of money to zero, and then figure out how to cut it below zero. That's exactly what happened, and it became the longest experiment in modern central banking. In February 1999, Japan became the first major economy to take its policy rate all the way to zero. In 2001, it invented quantitative easing, the money printing playbook every other central bank would later copy. In 2013 came quantitative and qualitative easing on a scale several times bigger. In January 2016, rates went negative, meaning banks had to pay for the privilege of parking money at the central bank. And in September of that year, Japan pinned even its 10-year government bond yield at roughly zero, a policy called yield curve control. Added up, and from 1999 to 2024, a quarter of a century, Japanese money was essentially free. Meanwhile, over that same stretch, American interest rates cycled between 0 and 5.5%, and US Treasury bonds routinely paid 3, 4, 5%. Now think about what that setup creates. On one side, a stable, near-zero borrowing cost. On the other, a persistent, positive return. Money is water, and water flows toward yield. So the smart money worked out the play. Borrow yen in Japan at basically no interest. Songit into dollars, and buy things that pay. US Treasuries, US stocks, emerging market assets. Your funding costs nothing. Your assets yield several percent. The gap in between is nearly free money. This maneuver has a name: the yen carry trade. Nobody designed it. It's simply the channel that water carves when one place is dry and another is downhill. How big did that channel get? This is genuinely the hardest question in the whole story. Because there are so many ways to borrow yen: bank loans, bonds, currency forwards, derivatives. And most of them don't show up on the same ledger. The Bank for International Settlements, which is basically the central bank of central banks, tried to size it in 2024 and gave a nested answer. The narrowest measure, directly observable cross-border yen bank borrowing, was about $261 billion. A middle measure, adding currency forwards and derivatives, came to roughly $1 trillion. The widest measure, counting all speculative bets against the yen, ran as high as $11.3 trillion. For scale, that top number is comparable to a third of America's entire annual economic output, riding on one assumption: that Japanese money stays free. And here's a detail worth underlining. Banks' cross-border yen claims hit 328 trillion yen, about $2.2 trillion, a jump of 52% from the end of 2021. In other words, precisely during the years when the Fed was hiking aggressively and the gap between US and Japanese rates was at its widest, yen borrowing wasn't shrinking, it was accelerating. This channel has flooded before. In 1998, when Russia defaulted and the giant hedge fund LTCM imploded, funds financed in yen all rushed for the exit at once. The dollar fell more than 15% against the yen in 8 weeks, including a single day in October 1998 when it moved 7%, still one of the wildest days in the yen's history. In 2007, as the subprime crisis began, the yen surged roughly 20% from its lows in another stampede. Notice something. In both episodes, Japan's interest rates didn't move at all. A global panic alone was enough to make the water flow backward. Hold that thought, because this time Japan's rates are moving. The trigger wasn't that the central bank wanted to tighten. It's that inflation finally came back. After the global price surge of 2022, Japan, the land of eternal deflation, saw its consumer prices climb. More importantly, wages moved. Japan's annual spring wage negotiations delivered an average raise of 5.110% in 2024, the biggest in 33 years. Then 5.32% in 2025. Then 5.26% in 2026. 3 straight years above 5%. The wage price loop the Bank of Japan had waited 3 decades to see. So on March 19, 2024, the Bank of Japan ended negative rates and yield curve control in one move. The world's last negative interest rate policy was gone. 25 years of extraordinary policy over. Markets shrugged that day. The real reaction came 4 months later. At the end of July 2024, the Bank of Japan raised rates again to just 0.25% and said it would trim its bond buying. A small step, but an unmistakable direction. Combined with a weak US jobs report, the yen strengthened 14% in under a month. Now, if you're running a carry trade, a rising yen is a margin call. You borrowed yen, every 1% the yen climbs, your debt gets 1% more expensive. 14%, levered, you're wiped out. Monday, August 5, 2024. The Nikkei crashed 12.4%, 4,451 points. Its worst percentage day since Black Monday in 1987. And its biggest point drop ever. The same day, the S&P 500 opened down 3.65%, fell as much as 4.25%, and closed down 3 point. The VIX, Wall Street's fear gauge, spiked above 65 during the session, a level seen only twice before in history. The 2008 financial crisis and March 2020 follow the sequence because it's the whole story in miniature. Japan raised rates by 0.25%. That strengthened the yen. The stronger yen forced carry trades to unwind. and the unwinding hammered Tokyo and New York simultaneously. A strategist at UBS estimated the dollar-yen carry position had peaked at no less than $500 billion, with about $200 billion unwound in the 2 to 3 weeks around the crash. The BIS later dissected how a quarter-point move became a global tsunami. The carry unwind itself, then trend-following funds mechanically selling as prices fell, then brokers tightening margin and forcing more liquidation, then a mountain of bets against volatility blowing up all at once. 4 gears meshed together, and the bias closed its autopsy with a warning. The acute phase passed, but the leverage is still embedded in the system, and liquidity can vanish in an instant under stress. In hindsight, August 5 looks less like the main event and more like a dress rehearsal. US stocks recovered within weeks and went on to new highs. But that's precisely what makes a rehearsal valuable. The full transmission chain ran once, in a live market, for everyone to see. And after the rehearsal, Japan kept going. Rates rose to 0.5% in January 2025, to 0.75% that December, and on June 16, 2026, to 1.0%, the first time Japan's policy rate has touched 1% since 1995. Officials have publicly floated a neutral level of around 2%, meaning by their own guidance they're not even halfway. Japanese core inflation is running at 1.6% and rising, with 3 years of 5% wage hikes still feeding through the pipeline. And the bond market is running ahead of the central bank. Japan's 30-year government bond yield hit a record 3.89% in early 2026, and the 10-year is at 30-year highs. A market that spent 3 decades paying nothing suddenly pays real money. That is the precondition for money to come home. Is it coming home? This is no longer a prediction. It's showing up in the data 3 ways. First, the forced sellers. Norin Chuking, the century-old bank that manages Japan's agricultural cooperative savings, loaded up on US and European bonds, back when money was free, then watched those bonds sink as rates rose. It ended up dumping 12.8 trillion yen, over $80 billion, of foreign bonds, finishing the liquidation in March 2025 and booking roughly $13 billion in losses. Not because it wanted to sell, because it had to. Second, the flow numbers. In the first quarter of 2026, Japanese investors net sold $29.6 billion of US government-related bonds, the biggest quarterly reduction in nearly 4 years, and accelerating month by month. One research team at TD Economics estimates that a sustained Japanese pullback from treasuries could push the US 10-year yield up by 20 to 50 basis points, that is, up to half a percentage point, added to America's benchmark borrowing cost quietly from the demand side. Third, the traffic in the other direction. In 2025, foreign investors bought a record 9.3 trillion yen of long-term Japanese government bonds. For the first time in a generation, Japan's own bond market is a competitive place to park money, and Japanese insurers and pension funds are noticing they can earn a decent yield at home without taking currency risk abroad. Why does this matter so much for America? Because Japan is still the largest foreign holder of US Treasuries, about $1.2 trillion, roughly 13% of all foreign holdings, more than the UK, more than China. That stockpile won't move overnight. But markets are priced at the margin, and at the margin, the biggest buyer is turning into a net seller. Now for the twist, the part that should genuinely make you uneasy. You'd think all this would have killed the carry trade. It didn't. As of June 2026, Speculative bets against the yen hit their highest level in 9 years, over 115,000 futures contracts. The dollar broke above 160 yen. Why? The rate gap, though narrower, still exists. The Fed sits at 3.50 to 3.75% against Japan's 1%, about 2.5 points of spread, still worth harvesting. Volatility is low, which makes leverage feel safe. So we get this strange standoff. Japanese rates are rising, repatriation is happening, and speculative yen borrowing is at a 9-year high. All three at once. The market is trading on the muscle memory of 2013 to 2023, in a policy regime that changed in 2024. And history's pattern here is uncomfortable. Every violent carry unwind, 1998, 2007, August 2024, arrived precisely when the consensus said, "This time it's fine." That's the structure of the trade itself. It earns pennies of spread day after day and gives it back in a single stampede. The bigger the position and the calmer the consensus, the heavier the steamroller. So what does the water flowing home actually mean for US stocks? Not a conspiracy. 3 perfectly mundane mechanisms. 1. If the largest overseas buyer of treasuries buys less and sells more, treasury yields face upward pressure. The 20 to 50 basis point estimate stacked on top of everything else. 2. The treasury yield is the anchor for pricing nearly every asset on Earth. When it rises, American borrowing gets more expensive, and stock valuations, especially expensive ones, get compressed. 3. When leveraged carry positions unwind, everyone sells at the same time, so volatility in global risk assets gets amplified, far beyond the original shock. And here's why this risk deserves a higher spot on the list than it gets. It's wired into the other risks everyone does talk about. America's AI giants are spending capital at a staggering pace. Big cloud companies' capex is already around 75% of their operating cash flow, and by some projections heading toward 94%, which means they'll increasingly borrow in the bond market to keep building. That whole flywheel assumes cheap, abundant global money. The cheapest source of global money for 30 years is the exact tap that's being turned off. Japan isn't just another item on the risk list. It's the plumbing underneath the list. Let me be clear about what this is not. It is not a crash prophecy. Nobody serious is telling you to sell everything. August 2024 itself proved these shocks can pass in weeks. The most likely path isn't a flood. It's a slow leak. Rates in Japan grinding toward 2% over years. The spread compressing until the carry trade quietly stops paying, and the floor under global interest rates rising a few dozen basis points at a time. Less a crash than a lowered ceiling on valuations everywhere. What this is the price of money undergoing a generational reset. If you want to watch it happen in real time, you only need 3 dials. The yen's exchange rate. 160 is the danger line for intervention. A rapid surge below 145 is the unwind alarm. Japanese government bond yields. Watch whether the 30-year takes out that 3.89 record. And every single Bank of Japan policy meeting. One last thing. In 1989, Japan believed land prices could only go up. That's how a palace garden came to be worth California. For the past 30 years, the world has held the mirror image belief that Japanese money would be free forever. The first belief took 3 years to shatter and 30 to clean up. The second one started ending on March 19, 2024, and the cleanup has only just begun. The tap is closing slowly, so slowly most people can't feel it. But the water meter is already running. For 30 years, the world gardened with free water. The next skill everyone has to learn is how to grow things when the water has a price.